515 was the high touched on the 30-year. Highest since October 23, 10 years on the move today as well. Jonathan Krinsky says the 30-year is likely going up, and the S&P is going to work its way back. It's about 57.20 is the number that he has in his mind. How much of an issue is all this?
I think it's an issue. It certainly got everyone's attention, from the chief strategist types to the chief economists. But we front ran, like we ran up into this actual deal, and now yields are flat to lower today. So the big news has already taken place. The 10-year, which is basically unched today, is up 44 basis points for the month of May. It's a very dramatic move. It was at 4.13% on April 30th. So this has been quite a run. 2-year yields up above 5%. There were two yields left above 5% still. Everyone's really watching the 20-year, 5.09. For me, that's the bigger one than the 30. The 30 is the tail that gets wagged by that 20-year tail. And again, it's the highest level that we've seen since October of 2023, when the growth outlook, frankly, was much better than it is today. So it's a very strange situation we find ourselves in. My personal opinion is that the confluence of a slowing economy and the AI impact on the labor market in the second half of this year, which we're already started to see evidence of, those are disinflationary forces. I understand that the tariffs are inflationary, or at least on the surface could produce supply chain problems that become inflationary. I think the market has to decide which story is more believable, that we're going to have supply chain shocks as far as the eye can see, or that the labor market is cooling, the economy is decelerating, and inflation's not the real risk. My personal opinion, it's the latter. I think the Fed will be doing more rate cuts than people think today, and I think the economic data is trending in that direction. And I can personally look through a 20-year or 30-year north of 5%. For me, that seems like the head fake.
Shan, how big of an issue is this if rates continue to back up for stocks?
Yeah, I mean, I think, once we start to get closer and closer to that 5% 10-year yield, then you start to see the impediment to, earnings, continued earnings appreciation. I think Josh makes a really good point, and I think it's one that we need to take a step back. There's a tipping point in the Treasury market between fear and greed. And so if you're an investor and you start to see 10-year yields kind of crest up towards closer to that 5% yield, that starts to look really attractive, especially against the backdrop of, admittedly, shorter-term interest rate cuts. Those are, we're going to continue to see the curve be pretty steep here.
They're obviously tracking one another, rates and stocks.
Right.
If you look at the movement today, for example, it's a pretty good indicator about the relationship between the two. You're looking at the 10-year. The 10-year yield moves down as we approach showtime, and the stock market moves higher. If rates were to reverse again, you start to get more nervousness. The NASDAQ obviously had some pressure on it earlier because rates were moving up. Now they're moving down. NASDAQ's green.
But the difference today between what we have seen over the past couple of years when we've seen rates on the rise is the fact that these rates are rising based on deficit expectations, fiscal sustainability concerns. They're not rising because we anticipate that we're going to see this kind of meaningful, economic shift.
Oh,
like
people try to make the argument, though. There's some in the newspapers today that are trying to suggest that all of you and a lot of you are making too much of the fact that rates are backing up because of concerns about the deficit, that it's more to do with expectations of higher growth. Now, you can say that's complete nonsense. Yesterday seemed to be a pretty good indicator of what the real deal appeared to be.
If that's the case, though, Scott, I think the difference here is, too, if we were banking on the Fed to get really accommodative to continue to engineer economic growth in the second half of the year into 2026, I think that's more of a concern but the Fed is a policy taker right now. They're not a policy maker. And so we're looking at the fiscal situation. Our view is that rates are moving higher based on those concerns, and that there is continuing to be some catalyst in the second half of the year and into 2026 for economic activity to grow once again based on improved business confidence.
In fairness, Joe, the economy's holding up better than than many people thought, okay? The consumer's been holding up better than people thought. I'm not suggesting that no part of the move in rates is anticipating a stronger economic backdrop, but there seems to be no denying the fact that if you're going to pass a $4 trillion tax bill, that given where the deficit already is and the cost of funding it is already a concern, you're gonna have a backup. Now, on the issue of the economy, Citi today talks about, quote, the calm before the storm, that they do expect growth to weaken in the second half. I have to tell you, I just got back from CNBC's CEO Summit out in Arizona, and to a person, you didn't really hear much gloom and doom out there at all from the CEOs who were in attendance. In fact, it was quite the opposite. I can tell you, corporate leaders like the rest of us are wondering whether the soft data is eventually going to turn up in the real data and bleed into the real numbers. Here's Marriott CEO Tony Capuano with me on stage.
I think the reality is this: our business thrive in times of stability and high consumer confidence. Neither of those have been in ample supply in recent months. However, the fact that you've seen this fundamental shift towards prioritizing travel and experience, we just did Q1 earnings. We beat on almost every metric. And we would have beat a lot stronger if not for March. January and February, we came out very strong. Then you saw a little bit of shock to consumer confidence in March.
All right. I mean, the point, Joe, is like everybody's talking about. All right, surveys have been horrific. We all know that. The data has not, the hard data, yet.
The perception, awful, pessimistic, but the reality is simple. The S&P is up 7% since April 30th, and during that period, the 30-year has rallied 50 basis points. I believe that what we have witnessed in the last 3 days is that bond markets, and not just U.S. bond market, but global bond markets, have basically said to the equity market, hold on, we're taking away your permission slip to go to the all-time highs. I still think we are positioned to go that way. And the technical reasoning for my belief there is, as long as we maintain above 5650 in the S&P, we could do that. But this is not just isolated to the U.S. And that's why I don't think this is really bonds are rallying on the expectation of growth. This is about long yields in Japan at their highest level since '99. We're seeing the same type of behavior in the bond markets in Germany, Australia, and the UK. So this is a global question where bond markets are saying, okay, what do governmental balance sheets really look like? And we're going to continue to have this need to borrow. I think what that means is we're in this moment where the S&P rally is probably on a pause until we resolve this. And I think, again, you look towards positioning. Central banks and pension funds are not coming to the rescue to be buyers of government bonds. That's not what's in front of us.
You still, according to Tom Lee, Jim, have firepower, his word, to drive stocks to an all-time high. We're only 5% away on the S&P. You know, before you had the little bit of a tantrum yesterday, right, last week before I went out west, we were talking, well, the S&P is only 4+%, and we're 5% away from a record high in the S&P 500.
So big surprise, Scott. I'm pretty optimistic. I think this was a stock market that was looking for a reason to consolidate, and it got one. But let's parse through what is happening in the bond market. I mean, the 20-year and the 30-year, and Josh, I think you were alluding to this, but you kind of pulled your punch. Who actually buys those? It's the people who buy those are insurance companies, pension funds that have long duration liabilities. I got it. You know what matters far more is the 10-year, because that's what businesses key off of in terms of their capital expenditures. And the 10-year, I'm not going to look right this second. What is it, 4.58%? I'm not freaking out about that. Now, yes, you go up towards 5, there's going to be a hiccup in the markets, unquestionably.
Rate of change, too. We can't always speak about absolute levels. They're almost meaningless.
Scott, I agree. We always have this conversation. I'm not denying what you're saying. I'm not. But what I'm saying is, actually, the 10-year has been kind of stable for a while. It popped up to 4.8 whenever that was, April. Got back down to 4.25. If you really look at it, and I'll give Ed Yardeni credit, he's been calling this, we're just kind of stuck in this 4.25 to 4.75% return. So I'm not looking at that. And I'm also going to say one more thing. Reason I'm optimistic, what you were saying, Joe, about international bond yields, yes, it's because there's borrowing and there's going to be growth from it. There's going to be growth. European defense companies are going to grow on this. So are American defense companies.